Most investors look at a stock that has plummeted 32% in 6 months and see a company in deep trouble. They see a 44% decline from yearly highs and assume the growth story is over. But what if I told you that while the stock price was cratering, the actual business was reporting its best numbers in history? Welcome back to the channel. Today we're breaking down whether SoFi stock is finally ready to break out and everything investors need to know before the next big move. We are looking at one of the most polarizing setups in the market today, a classic tale of two realities, where the ticker symbol and the financial statements seem to be living in completely different universes. If you find this breakdown valuable, do me a quick favor and hit that like button and subscribe so you never miss an analysis like this. It genuinely helps the channel grow. So to understand why the market is treating a record-breaking company like a failing one, we have to look at the massive structural shift happening behind the scenes. On one side, you have the market reality, a year-to-date decline that has left shares sitting at around $18.78, struggling to find a bottom. On the other side, you have the business reality. SoFi isn't just a bank anymore. It is aggressively transitioning into a high-margin technology powerhouse. They are launching AI-powered investing tools, moving into small business lending, and even dropping specialized ETFs. It's a bold attempt to escape the cyclical lender label that keeps bank valuations low. But as we'll see in a moment, this transition is exactly what's causing the accounting scrutiny that has the bears so excited. This evolution isn't just about new logos and apps. It's a fundamental rewrite of their DNA. The old SoFi was a cyclical lender. They were dependent on student loans and hypersensitive to interest rates. It was capital heavy and frankly risky. The 2026 expansion is the opposite. By diversifying into capital light, fee-based revenue like the SFY ETF and AI-driven trading through their acquisition of Composer, SoFi is targeting a massive 38% EBITDA margin by the end of this year. They want to be valued like a software company, not a credit union. But here's the curiosity gap. If they're becoming a high-margin tech giant, why did the market reject their last record-breaking earnings report? The answer lies in a single word that every growth investor dreads: caution. In the first quarter of 2026, SoFi delivered a breakthrough. They hit $1.1 billion in adjusted net revenue, up 41% year over year, and a GAAP net income of $167 million. On paper, that's a home run. But management did something unexpected. They left their full-year guidance unchanged. Investors didn't see stability. They saw extreme caution. The rally stalled instantly. It's as if the pilot told the passengers we're flying at record speeds, but then refused to promise we'd arrive on time. This lack of forward aggression has left the stock vulnerable to the one thing SoFi cannot control: the Federal Reserve. And when it comes to the Fed, SoFi is sitting on a high-stakes teeter-totter. SoFi's sensitivity to interest rates is unique. A simple 100 basis point drop in rates is projected to add nearly $160 million to their net interest income. That's pure profit. But if rates stay high, or worse, climb, their funding costs skyrocket and their student loan refinancing business, the original bedrock of the company, remains under threat. We have CPI data and megabank earnings from JP Morgan and Goldman Sachs coming up this week. Those reports will dictate the sentiment for the entire fintech sector, and SoFi is right in the crosshairs. But macro data only explains part of the price action. The rest comes down to a very expensive identity crisis in the valuation. The market is currently demanding hyper-growth to justify SoFi's valuation. At a 41.3 times price-to-earnings ratio, SoFi is being priced like a tech darling. If you compare that to a traditional bank, it looks absurdly expensive. This is the core of the bear case. The market refuses to price SoFi as a bank. But if SoFi fails to deliver software-like growth, that 41 times multiple will collapse. It's a high-wire act where there is no safety net for a missed earnings beat. That sounds risky until you look at who is actually putting their money on the line. Smart Money is making a very clear statement here. Cathie Wood's ARK Invest just added another $1 million worth of shares to the ARK Innovation ETF. Even more telling, CEO Anthony Noto just bought nearly 14,000 more shares with his own money at around $18.06. He now owns nearly 12 million shares. When a CEO is buying the dip this aggressively during a 30% drawdown, it's often because they believe the market is missing something. They aren't just buying a bank, they're buying a platform that just integrated a sophisticated AI rules-based trading engine via the Composer acquisition. But for every bull like Noto, there is a bear with a very loud microphone. We cannot ignore the battlefield. Short interest is sitting at a massive 15% of the float. That is an incredible amount of betting against the company. A lot of this stems from the Muddy Waters report, which alleged Enron-esque accounting and aggressive marks on personal loans. SoFi has vigorously denied this, but the allegations act as a heavy weight on the price action. However, here's the interesting flip side. 15% short interest is explosive fuel. Any positive surprise, like a SpaceX-related headline or a macro beat, could theoretically trigger a short covering rally that sends this stock vertical. This tension has created a complete civil war among Wall Street analysts. The street is sharply divided. On one end, you have KBW with an underperform rating and a $16 target, essentially saying the new products won't move the needle. In the middle, Goldman Sachs is turning bullish, raising their target to $21. And then you have the ultra bulls at Citizens JMP, who see this as a $30 stock. That is nearly a 100% spread between the bears and the bulls. It's rare to see this much disagreement on a mid-cap stock, which tells you we are at a generational crossroads for the company. So who is winning the fight? The charts give us a very specific answer. Technically, momentum is actually building. The 14-day RSI is at 59, which is neutral bullish, meaning there's plenty of room to run before it becomes overbought. We found a solid support floor around $17.56, and the MACD is showing constructive upside pressure. But, and this is a big but, we are staring at a massive wall of heavy resistance at $22.13. That is the 200-day moving average, and the stock hasn't been able to breathe above that level for a long time. This struggle between support and resistance has squeezed the stock into a very famous pattern. We are currently inside a symmetrical triangle. Buyers are defending higher lows between $17.70 and $18, while sellers are pushing down the peaks. This is a volatility squeeze. The trigger point is around $20.10. A confirmed daily close above that level would validate the breakout and historically open the door toward the $25 zone. Until that happens, the stock is just vibrating in a range. But the moment that level breaks, many analysts believe the shorts will start to scramble for the exits. To understand this setup, it helps to know exactly where the floor is and where the so-called magnet is pulling the price. Here is the tactical map. The current price is around $18.78. There's immediate support near $18 and a must-hold floor around $17.40. To the upside, there's an intraday high near $19.19 and that psychological $20 breakout level. But look at that top number, $22.41. That is the convertible note price floor. It acts like a long-term magnet. If the stock gets above that level, the fundamental narrative shifts from struggling lender to successful tech transition. But there's a catch. Exceeding that level also increases the risk of share dilution. So why would anyone take the risk? Because of the one metric that suggests the Everything app is actually working. This might be the most important number in the entire report, 43%. That is SoFi's cross-buy rate. Nearly half of their members are adopting multiple products. This is the flywheel in action. It costs SoFi a lot of money to acquire a member, but once they're in the ecosystem, every additional product they take, a loan, an ETF, an AI trade, becomes margin expansion. This is how they drive down customer acquisition costs and build a moat that traditional banks simply cannot match. Now, let's talk about how different investors are approaching this setup. There are broadly two mindsets here. The aggressive trader is watching the consolidation zone in the high $18 range, treating that $17.40 floor as the line in the sand for risk. The risk-averse investor takes the opposite view. For them, this stock is essentially a wait and see. They want to see a daily close above $20.10 on high volume first. They pay a higher price, but they're buying confirmation that the trend is actually reversed. Neither approach is right for everyone, and that's exactly why the next event matters so much. And that brings us to the ultimate show me moment that will decide SoFi's story for 2026. July 29th, mark your calendars. That earnings report is the final test. If they can show that the AI tools and new ETFs are actually accelerating that 43% cross-buy rate, we could see a move that ignores the dilution risk and challenges the $25 level. SoFi is a high-conviction growth story currently trapped in a cage of technical resistance. The bottom line? The area around $19 and $20 is where the entire battle is being fought. Above it, the bulls take control. Below it, the bears keep the keys. Now, before we wrap up, a quick and important disclaimer. I am not a financial advisor, and nothing in this video is financial advice. Everything you just heard is for educational and entertainment purposes only. All investing carries risk, including the potential loss of your capital, and price targets and predictions are never guaranteed. Please do your own research and consider speaking with a licensed professional before making any investment decisions. With all of that said, I want to hear from you. If SoFi delivers a blowout earnings report on July 29th, do you think it finally breaks that $20 wall, or do the shorts win again? Drop your price target in the comments below. I read every single one. And if this breakdown helped you see this stock more clearly, please smash that like button and subscribe for more deep dive analysis just like this. Trade smart, stay objective, and I'll see you in the next one.